All right. Want to thank you guys all for joining. This is being recorded. I always mention this at the very beginning when I talk about the recording is watch it again. You know, I came from a psychology degree, and one of those things that we kind of learned with that was that if you have a repetitive motion, or if you learn something new and you review those notes, say shortly thereafter, you are more likely to learn that rather than just memorize. And as we know, memorization kind of fades quickly, but when you learn it, you will have the ability to keep that for a longer duration. So even if you even if you are familiar with this strategy, I'm going to be talking about some rules that I have that you aren't going to be able to find online and things of that nature. So you're going to be learning some of these things new or memorizing at one point. So watch it again so that you actually learn it, so it sticks in your head. And if you're newer, a lot of these concepts are going to be flying by you. Ask questions. I'll try and go over them again, but you know, some of those times when you're trying to think of asking a question, you might miss something along the way. So again, very important to rewatch this and watch it relatively soon after when we send this out to you. Don't wait a month or so, because it's going to be like learning it all over again. And I don't know why I started it up that way, but this is options for intermediates too. So we've done the beginner options, we've done beginner to intermediate. Now we're starting to get into a little bit more advanced strategies, and they're carrying a little bit more quote unquote higher risk, as the regulators would have you believe. To me, that higher risk actually is a higher probability of success. So I don't know how they necessarily look at it as in high risk, because you're selling premium and that's unlimited in a sense. And when you're buying options, that's limited. You know what your risk is. But when you're talking about probabilities of success, if you're buying options, your probability of success is lower. And if you're selling options, your probability of success is higher. So what's more risky? Well, to me, buying options seems to be a little bit more risky. Yes, you do have that in the back of your head where you could lose more money than you're able to make, but when the probabilities are in your favor, that to me counterbalances that a little bit more. So that's how I like to trade, is in selling premium. And this is a premium selling environment, to say the least, if you've been watching the markets. You know, with premium selling strategies, you want that high volatility to happen, but then to settle down. And if you've been watching my daily market commentaries, I've actually been expecting a little bit of the shakeup, and now for it to settle down. I've been a little early, obviously, but that's my market assumption. So we all have our market assumptions. That was mine this week, and I've been putting on strategies similar to what we're going to be talking about today for that very reason. Farshid, I hate premium selling, but it does make money regularly. It keeps you on your toes for sure. But when you have, a 85% probability of success, then, that's a pretty good risk reward as far as I'm concerned. So that's why I like to play those premium selling strategies. And Farshid, this is going to be a defined risk premium selling strategy. So this is one of those that for newer traders, when you're getting a little bit more advanced, this is a great way to get your feet wet and step into those premium selling strategies. We have limited risk on it, so we will know ultimately what we're going to get into. And the beauty in this strategy is there's so many ways to play around with it and be mechanical to defend that strategy. If you got, like, again, if you've been watching the daily market commentaries, IBM was testing me this week, and I was going to get a little aggressive. We got that bounce, and so I was happy with that. It did get out of it because I didn't want that risk anymore, but at the end of the day, that's what I was looking at and talking about in those daily market commentaries. Yes, in the current environment, you should only be selling premium for the, depending on the underlying. There are a few of them that have low implied volatility, but for the most part, we're going to be in this type of environment looking for premium selling strategies, because it is at the highest we've seen in even a couple of years, to be quite honest. Anyway, a couple of things get out of the way. My name is Eric Wilkinson, you guys. I've done stuff on CNBC, Fox Business, Wall Street Journal, talking about economic, geopolitical, and market analysis. Not here to tell you guys that I'm going to make you a millionaire, but I am going to teach you how to create consistent winners and help you take control of your finances is really what this is about. Taking it out of the hands of somebody else and taking it into your own hands and making your own decisions, as far as I'm concerned, is the best way to get your portfolio in order. Anyway, in that time, I actually started out trading in college with a psychology degree, kind of mentioned that a little bit earlier. And when I started trading, I was like, hey, I kind of got this. And switched it over to finance. After graduating from college with a finance degree, I moved up to Chicago and started trading in the pits. I actually started out as one of these runners and then sold all my stocks, cashed out, bought myself a badge, backed myself, and been trading my own money ever since. And I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products, basically in all market conditions. Wasn't trading in the 80s, so it was probably in the 90s is when I first started trading. Close to into the 90s anyway. All right, got to go over this disclaimer also. I'm sure everybody's heard of this before, but basically all this is saying is that anything that we provide is for general commentary. It does not constitute investment advice. And the reason why I can't offer you investment advice is because I don't know your risk parameters. I don't know what's in your portfolio. And, what I'm talking about could be absolutely counterintuitive to what you are already doing. So what we're doing is trying to teach you these different tools that you can implement with your own market assumption, in a sense. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, this is the short iron condor. And what is an iron condor? Basically, with the iron condor, we are defining the risk on the upside and the downside. So we need this underlying to trade in a range. We don't want it to go too far up, and we don't want it to go too far down. We just want it to kind of trade sideways or be very market neutral. And like I said, I've been starting to get market neutral. We've had all this volatility. And when you have a lot of volatility moving back and forth, it starts settling down. And I believe that that's what's going to start to happen if the talking heads get their stuff together, really. Anyway, so like I said, range bound, but we want volatility collapse. And what we used to call it on the floor is volatility crush. But we want volatility to start coming out after we've experienced high volatility. And we've experienced high volatility for, a couple of months now, to be quite honest. It's up into the 20s. Some people are saying a VIX 20 is to 2018 as the VIX 10 was in 2017. And if you're not familiar with the VIX, basically it is a broader market gauge of volatility for the equities. Okay. And what I usually talk about is implied volatility, and that has to do with the volatility of a particular underlying. Okay. And that's what we're going to be talking about with volatility. When we're talking about high volatility, yes, we could be in a high volatile market, but some underlyings may not be experiencing that same volatility. All right. So we want to see if the underlying that we're looking at has high implied volatility, compared to itself. Because, Tesla has a high implied volatility. It doesn't necessarily mean that just because Procter & Gamble has a high volatility that they are going to be equal. Tesla could have like a 30 implied volatility, and Procter & Gamble may, I'm throwing this out, a thin air, and say, Procter & Gamble or a utility would have something like around or 20 implied volatility, but both of them are very high because that's for itself. Okay. And I'll show you some examples of that here in a minute. All right. One thing to note is, what is a strangle? Basically, a strangle is a short call and a short put that are out of the money. Well, what do we do to build an iron condor? We define that risk. So it's just a strangle with defined risk. But we are going to have rules on defining that risk. I have pretty solid rules on defining that risk, and we're going to talk about that. Adding a call spread to a put spread is another way to look at it. You got a short call spread and a short put spread. Basically, when those get squished together, you have your short iron condor. And this is another way to look at it. If you're more visual this way, if you look at a short put spread, you have the defined risk. This would be your max loss. This would be your max profit. You have a short call spread, max profit, max loss. Well, what happens when you slide those two together? You get the iron condor, and this is what it would look like on an analyze tab, relatively close. This is probably closer to a 50-50 risk reward, and we're not going to achieve that. But one thing to really note, and this has to do with the bell curve, kind of. If you think about this as being a bell curve, when you have low implied volatility, this is much narrower. These lines are squished together, whereas when you have high implied volatility, you get a lot more wiggle room. Now, setting it up in a low implied volatility environment, this is your short call, your short put, short call, short put. Now, these could be the exact same underlyings, just in different implied volatility. Okay, this is when it's high implied volatility for itself and low implied volatility for itself. And what happens is these are still the same delta strikes. These will be the same delta strikes, but you can see that delta is much further away. Okay, because we're experiencing that volatility, the probabilities are that it could cover a greater area. And then when it settles down, then it gets back to normal. We kind of have that zone in here where we have high probability of success. All right, so some of the essentials to success here is picking the right underlying. How do we know what the right underlying is? Well, we all look at different stocks, but just because a stock is talked about on CNBC or you see it out on Twitter or something like that does not mean that it is appropriate for especially a newer trader. Somebody that's been trading 20, 25 years will be able to figure out, have a little bit better idea as to what value is. But in the meantime, let the market decide what value is, because that really what happens is the market comes in and that's where value is. If you go into something with a real wide bid ask right here, that means there's not very many players in there. There's not very many people trading that particular underlying. So that means you're basically talking to one person, trying to get them to, come to your price in a sense. Whereas, you go to a farmer's market and everybody has oranges. Well, the probability is if you're the only buyer, you got pretty good idea as to what the real market is, rather than just one person selling oranges in a sense. But essentials to success, picking the right underlying. If we have this underlying we're looking at, come over here to the options with less than 50 days. I like to look at the one that is the monthly, that is the closest to expiration, because that's where there's a lot of people. And the idea is, if a stock is over $100, just move the decimal place 3 ticks to the left, like here in Facebook. So 15 cents wide is how wide this bid ask is. And you can see these are 15 cents wide. So that would be an appropriate underlying to trade. And if you guys have traded Facebook a lot, these are really wide markets for Facebook. And as a matter of fact, they were wide all day long, right around that 15-cent mark. When there's low volatility, these markets are going to come in, they'll be like 5 cents wide. That's what happens when volatility expands, is the markets get wider. So that's why when we're getting into strategies, we want to make sure we're following this rule that the bid ask needs to be, for a stock over $100, move it 3 ticks to the left. That's our bid ask. You can even do it with $1,000 stock. We looked at Google, 3 ticks to the left, $1 wide. So we go and look at the ones that are closest to the at the money. And these were working out earlier today when I was looking at it, $1 wide. So you can see this is the monthly that obviously everybody's in, but it's $1 wide. So we may have to go out a little bit further. People, you get inside of that 15 days to expiration, people start bailing on that option and rolling out to the longer duration. So as you can see, $1,000 stock, dollar wide, that makes Google fit that rule. We can look at something like that's smaller. So let's look at GE. Anything that's a stock under $100, we just move the decimal, or we don't even have to worry about the decimal. We're just looking at 10 cents wide. Stock under $100, it's got to be at least 10 cents wide, okay? If you're looking at like a $10 stock, you should probably be seriously thinking that it should be about a nickel. But we can look at even like JP Morgan, 10 cents wide. It's a stock that's close to $100. Microsoft under $100 is probably going to be inside of it. Of course, they're going to show me that it's not, but that's the idea. Microsoft will have tighter markets during the day session for sure. So that's the idea. Stock under $100, bid ask, we want it to be 10 cents wide. Anything over $100, just move that decimal place over. Another thing you can see is you look at volume and open interest. That's a lot of open interest and a lot of volume, okay, for any underlying for that matter. That's when you know there's going to be tighter bid asks, okay? That means even if you saw a market like this and you saw this open interest and volume, we used to call it everybody's in the weeds. They want to get out as bad as you, but they're seeing volatility's high, so they're not willing to give up that much edge. You might be able to come in here and bid $1.80 for this strike, or offer $1.95 for this same strike, but you're offering it. You'll probably see somebody come in $1.80 bid, or maybe $1.85 bid because they really want to get out. They just don't want to pay up to $2. And it's that whole, it's almost like that barter, or not bartering, but dickering, I think they call it, where you kind of go back and forth and try and meet at the price. It's kind of like that. All right. So with these that you see a lot of volume and open interest, don't go to the mid-market right away. It doesn't cost you anything to put a bid or an offer in and cancel and replace it. I highly suggest you really do that, all right? Making sure you do that due diligence. Get outside of where you think, because you never know how bad somebody else wants to get out. They might be just waiting for you to uptick it a little bit. This market is something else. I know you can make money with volatility, but this market is crazy. I'm not going to disagree with you. This market is crazy, but keep in mind, 1,000-point moves in the Dow just don't happen every day, unless it's 2018, I guess. But the idea is, when there's blood in the water, you guys, that's when you go fishing. I mean, I can't explain it enough. It's like, you'll talk to these people and they're like, when this stock gets to this level, I'm going to buy it. And then it gets to that, well, I'm going to let it breathe. And then they miss it. I don't know how many times I've seen that, right? But it is the time to stick to your guns. And if you're selling puts and stuff like that to acquire stock, I would stick with that. Yes, the market can go down, but stick with that strategy, because it is going to come back to normalcy. But the idea here, tight bid ask, all right? 10 cents under $100, and move the decimal place if it's a stock over $100. All right, picking the right duration. Premium selling strategy. We're short iron Condor, right? We are collecting money. We want theta decay to happen. So we want to be inside of this zone. And these are the at the monies. I'm not going to split hairs with you guys. We aren't doing the at the money strike. So this theta curve does look a little bit different on the out of the monies. But at the end of the day, we can agree, or I hope you will agree with me, that theta starts picking up the closer you get to expiration, all right? And what we want to do is get inside this zone. Right now, we're inside of 14 days. Yes, there is a lot of theta decay going on here, right? Why aren't we just doing that, Wolfman? Well, you get inside of this 7 days, and there's a lot of stuff that goes on there. There's gamma. Gamma starts increasing. So, the ones that are closer to at the money get juked around. And believe it or not, big money likes to push stocks to where they want it in these last 7 days so they can pin their strike. So I'd rather not be involved in those reindeer games, or whatever you call them, in that last 7 days. I love to be out even 14 days. 7 days. That's where I like to be out. So I like to put on my strategies for short premium selling strategies. 45 to 35 days to expiration is the wheelhouse. That's the go zone for me, and we are just inside of that. Basically on Monday we're going to be right there, right? So we start getting that accelerated theta decay, and if you get volatility to come in or collapse, crush, however, what happens when there's volatility like we're seeing right now, this is a normal theta curve. Well, when we get volatility starting to come into the market, what happens is it's kind of like a balloon getting pumped up, and volatility holds off. It's not exactly really holding it off, right? But it really feels like it. It feels like it's holding it up. It's holding it from decaying. And then when that volatility comes out, it catches up. And that's kind of like the idea of what we're looking for. This is just theta. This has nothing else in it. It doesn't have the market moving. It doesn't have volatility involved. It is a normal theta decay curve, and what happens with those premiums. Every day they start decaying. We used to call theta the thief in the night that would come and steal your premiums. That's what we want. We want that. We left our doors open for this thief to come and steal it. And we want this volatility to come out because it holds it up for a while. And if we can get that volatility to come out while we're in it, it happens fast. You can get in and out of these strategies quickly. All right. The next thing we're going to be looking for. So we got this. We want 45 to 35 days. You know, you can go inside of 28 days. I've been doing it this month because next month is starting to look like the earnings are showing up again, and I don't want to put this strategy on right now and have earnings coming up, right? If I'm putting on the May options and they have earnings in May, what do you think happens around earnings? Volatility goes up. It can even go up from where we are here because it's around earnings. That's just extra volatility. So I don't want this strategy to be in and around that earnings trade when we're this far out. You know, earnings, if I set it up the day of the earnings, that's a different story. And I have webinars how to do that to set up for earnings trades. But this is outside of earnings. This is a trade we want to put on because we expect it to trend sideways and volatility to come in. That's how we're playing this, about 45 days out. If you have an earnings that's going to land like right here, let's say, you know, what if the earnings is right here and I put this trade on here? Volatility is not going to come out until after that event, and it will likely continue to go up. So what happens if that volatility is going up? That means our premiums are going up. We don't want that. We want, because you could be directionally right. There's market trade sideways and volatility goes up, and you could see yourself not making too much money. So we want the volatility to come off. And I see you guys are getting a couple questions out there. So let me get it real quick. What was it? When in the current environment, you should only, I did that one. Oh, I'm only fishing. Yeah, we are all fishing. We're always fishing. Question, if option is the 75-20, you would say you can try to buy at 180 or sell at 95 and hope for you to get filled. Does the market maker move? Neil, I don't know what context you're talking about with if the option is the 75-20. Are you talking about a short call spread on a particular one? I might have passed up before I saw that. So if you can explain a little bit earlier. So next Wednesday, premium falls. Larry, I hope premium falls next week. I've actually been saying, you know, if you're a premium seller, you're just begging for this volatility to come in. Because, you know, if you look at the charts, we really haven't gone anywhere for the last 2 weeks. We've had 700-point moves, but we're really right back where we were. So, you know, the volatility is tough, but we haven't really gone anywhere. But in this case, we do want volatility. We have the assumption volatility is coming out. And how do we know? We want high implied volatility, above 50% implied volatility percent for a stock, and for an ETF above 30. So, you know, I put the implied volatility percent right here in my watch list, and I have the script for our premium members that can throw that in there. But this tells you where implied volatility percent is for that particular underlying. IBM's at 100 ID percent. And we would want that expectation of volatility coming in, right? So for a stock, we want high implied volatility, that being, I'm getting ahead of myself. But let me get this next. I got onto an earlier one. Picking the right strikes. This is really important, you guys. This is a bell curve. And this is what I was talking about a little bit when we were showing that bell curve earlier. Let me make sure I still have my pen. But if we have high implied volatility, let's say this is a normal distribution curve, right? If we have high implied volatility, what happens is this curve will kind of look like this, where it goes up and then it stretches way out and it comes down. Okay, that's an exaggeration, right? But you get the idea. So then your lines kind of go out like that. Now, if you have really low implied volatility compared to this one, you're going to see that distribution curve go like that. All right, and of course that's another exaggeration. But the idea is, where would you rather have your, try and throw your dart, at this one or at this one? To me, I'd rather throw it at this one, with the expectation volatility is going to come in, right? And you wouldn't want to do this one and volatility expands, because then all of a sudden, well, my probabilities were I was only going to go to here, but when volatility expands, now the probability of it getting to here is a realistic, happenstance, for lack of a better thing. So what is one standard deviation? That's what we're going to start looking at with this option strategy. One standard deviation means that 38% of the time, this stock is going to kind of finish somewhere in here. And basically, 38% of the time, which means 32% of the time, it's going to land out here. So the idea with this strategy, we have a 68% probability of success if we were to pick that exact one standard deviation strike, which we likely are not going to be able to do, right? And I'll show you why. But what happens is, when you add up all these probabilities, you can see on this side, you add up all of this, that's right around 16%, once you put it all together. And then on this side, it's 16%. So we got a 16% probability of our puts being in the money, and a 16% probability of our calls being in the money. It's one or the other, right? But we have a 68% chance of it landing somewhere in here where we get paid on both sides, right? So that's how this distribution happens. And the same thing goes up here. Then 64% of the time it would land in here. 64% of the time it would land in here, okay? So one standard deviation to the upside or downside is equivalent to a 16, not percent necessarily, but delta, okay? That's how options work, you guys. That's a 16 delta. So we can say a one standard deviation here is a 16 delta, or a 16% probability of being in the money. They're cross-correlated, all right? So keep that in mind as well whenever you're looking at a probability curve. That's the delta. Same thing with a two standard deviation move is it's right around a 2 or 3 delta, really. 2 to 3 delta, depending, which means it's only about a 2% probability of being in the money at expiration, right? God, I'm a good drawer. I should have been an artist. Anyway, I'm kidding. All right, so that is picking the right strikes. We want to start with trying to look at that one standard deviation. It's not going to be the one standard deviation. We're going to come inside of that just a little bit to get the proper risk-reward ratio for our strategy, and I'll show you how to do that in a minute. But picking the right environment, we've talked about that. We want high implied volatility. So for a stock, if we do a stock, and I'm going to abbreviate it because I can't write, we want it implied volatility percent to be above 50%. Okay, whoops, 50%. I'm going to stop drawing here. And for an ETF, thought I would be able to do this with my pen, but it's not working out very well. An ETF, we want it to be above 30. Why is an ETF lower? Because it's a basket of goods. It's got a bunch of things inside of it, and that volatility is going to kind of mellow out each other. Some of them are going to have real low implied volatility. Some of them are have real high, and those will kind of mellow each other out. So we want an ETF to be above 30 IV% and a stock to be above an IV% of 50. And that's for itself. I'm not talking the VIX, you guys. And here, so let's take a quick look here. So this is where you can find implied volatility percent right here for Microsoft. It's 81%. Now, if we look at the charts, I have a chart of implied volatility for Microsoft in and of itself. And if we do the math, we would come out with the same thing that Thinkorswim has here. But the math that goes into finding implied volatility percent is you take where the current implied volatility is, which is what does that say? 32. Sorry, that's being over in the corner. 32, let's call it 33, just round it up. So right now it's trading at 33. We go take the, okay, so we have a fraction here. In the numerator and the denominator. In the numerator, we take the sum of where it is currently minus the low, which is, right around 11. So 33 minus 11. So in the numerator, we have 20. Or sorry, 30. What did I say it was? 33 minus 11. So in the numerator, we have 22. Yeah, 33 minus 11 is still 22. So in the numerator, we have 22. And in the denominator, which is on the lower side, we take the high minus the low. So the high here being 38, 37 minus 11. So that's 26. So basically you look at 22 divided by 26, and it should come out somewhere, with me just ballparking, 22 divided by 26 should be somewhere in the 80s, I would think. So it's very close, 84, and that's because I'm rounding everything off, I'm ballparking it. But the real number is 80. So that's how you figure that. And that's really important because there's some things like we could even look at like SPX, and we're going to see implied volatility spike right here massively. Well, look how high it's spiked in the past like that. We could probably go back a couple of years and not even see that kind of spike. So sometimes there's a crazy spike. Medical device companies or drug companies will have these spikes a lot of times, and it has to do with a trial result on a drug, and you'll get these massive spikes. Well, they might not have a trial result for another 3-4 years, and that's going to throw off our calculation for at least the next year. So, it is, I will do this where I discount that and say, okay, this is really going to be the high. We're experiencing something really different right now with higher implied volatility. So I'm not necessarily saying that that's what I'm going to do all the time, but I'm saying, if you see a massive spike out of the blue that's just throwing off all the math, you can discount that and use your current divided by, or current minus the low divided by the high, which minus the low, and this would be in the 90s almost, okay? Does that make sense for everybody? So know that math, where the current is minus the low, take that sum and divide it by the high minus the low, and that's where you get your implied volatility percent. What is the blue histogram you have to the right side of the chart, and how do you get that in TOS? Those are the blue area, and these little dots are, it's basically a market profile, and it's market profile and monkey bars. And what it does is it tells you where the most amount of time and volume has been spent. And this so happens to be the most time and volume has been spent in Google right here at around $950. That's where people put their money where their mouth is. And I've got a whole webinar on how to trade that, but that's what that is. It's it's really great. And when you start throwing Fibonacci's around it, you'll be amazed at how all that stuff lines up. So that's how we find implied volatility percent, okay, through that. And I think if we even look at like something like Merck, you'll see Volatility Crush. I think Merck really has a good, no, that's not that one. I don't remember who I was looking at earlier, but they had a really good chart on implied volatility percent, how you get Volatility Crush after the earnings and stuff. But that's what we want. We want this kind of catch it on the high and start getting it when it starts coming out, all right? Catch it when it starts settling down. And this is what I was talking about, like even with all these stocks, look at that. That's really pretty much trading sideways. There is a lot of volatility in it because there's big moves happening. But to me, this is when things are going to start settling down a little bit. When you start seeing it get a little crazy, people will start settling down. All right. Is there a way to see anyone's questions? No, Brian. And I'm sorry. I try and read them out. Sometimes I don't do that, but I do try and read them out. Sometimes I don't do it because I'm like, okay, it took so long to read that. I might as well just answer it because there's a lot of dead air in here. All right. And so that is the right environment. We want high implied volatility anytime we're selling premiums. All right. And that's going to be like throwing or shooting fish in a barrel right now with high implied volatility. All right. And then finally, knowing your exit strategy. Okay, this is an iron condor. One of the things I will do is go a little bit less if we are in this trade for a very short period of time, let's say like 10 days or something like that, and you're at like 25% of your max profit, you can get out. Well, that with the iron condor works if you have, let's say you're trading 5 contracts or more on the options, or a 5-lot tranche is what we used to call it, or a 10-lot tranche. But if you're doing 1 lots on this, you are going to have to at least get 50% of your max profit, okay? And maybe even a little bit more. I know with even my IRA, I have to go for a little bit more on that because I'm not doing massive quantities in that. So if you're using lower quantities, you're going to have to shoot for 50% of your max profit. All right. Now, what are we doing with this? We are looking with the iron condor to get a third the width of the strike. So if it's $1 wide, we're trying to capture 33-cent credit. Okay. Which means that our max loss is 67 cents. But that's what we're shooting for. We're trying to build this out. We need to at least collect a third of the width of the strikes. Yes, you can collect a little bit more, but you are going to have to be closer to where the underlying is trading in order to achieve that. If you go for less, you are going to be further away and have a higher probability of success, but you're going to have to ride this a lot longer because you're going to have to try and pay off your commissions and still make some money, right? And when you're doing that, there's a lot of risk on your part and not so much on your trading firms because they're making all the money on the commissions. They want you in and out. They don't care if you make a profit. All right, so our max profit is that net premium received minus the commissions. And remember, we're going to have to get out of this as well. I'm not going to ride this into the sunset and try and let it decay and expire worthless. I think your probabilities of success are much less. So I'd rather get out, move on to another trade, and just keep churning and burning them. Because if you get out early, your probabilities of success with this is like around, like I said, 70% probability of success. That's at expiration. If we get out of it early, our probabilities, back of the napkin math on stuff that I've done, this strategy moves up into the 80 pluses. And this year might be a little bit lower. I'll have to wait. But historically, it goes from about a 70% to somewhere between 80 and 83%, I think, is what I have for my probabilities that I have done. Now, everybody can say yes, and it's true. Well, maybe you're picking the right stocks at the right time and the directionality and all of that stuff. Well, maybe. I may very well be. But at the end of the day, it's what I found, and I can't publish it because it becomes a solicitation. but it's somewhere close to, it's higher. All right. You'll have to keep track of your own. And then call me out if it's not right. Please call me out. All right, so max loss is the long call minus the short call. Basically, all we're doing here is I'm trying to make this math so it doesn't come out negative for you. But basically, it's the width of the spread minus the net premium. So like I said, we're looking at $1 wide. Our max profit on that $1 wide was at 33 cents that we collected minus the commissions. Our max loss is the width of the spread. So if we're collecting a third the width, that would have been $1 wide. So we have $1 wide spread, 33 cent collection. Our max loss is 67 cents. All right. Now that goes or, because you can't hit the calls and the puts at the same time, right? The market can't split and go to both directions at the same time. So this also is at expiration. All right. That's at expiration. All of these are at expiration. And our break even is the underlying price, when the underlying price, I should say, is trading at the short call strike plus the premium or the short put minus the premium, okay? Because when we collect a premium, that increases our break even to the upside and increases our break even to the downside, right? It's a little bit further out because I got a collection of credit. So that moves it that way, right? If you only have one leg, what's the risk? What do you mean? If you only have one leg, what's the risk reward ratio of the spread? Just want to compare it to the iron condor of 1 to 3. I'm not sure what you're saying there. Bull put spread or a bear put spread. Well, if you were going to do one or the other, then if you had a directional assumption the market was going down, then I would just do the bear call spread. And then the bear call spread is going to have about an 85% probability of success. And actually the naked is going to be a higher probability, and the naked short call or short put is going to have a higher probability of success, even further than that, the way I teach it anyway. All right, because we're getting out early. I go over, you guys, I go over all of those probabilities, like on the bear call spread, the bear put spread, long call spread, and probabilities in those in webinars. I just can't really throw it out right now. All right. If you did it as a credit spread right now, your probabilities of success are about 30%. You just flip them. Okay. All right, so without further ado, let me get this platform up here. This is usually at the part of the webinar where I throw it out to you guys. Give me some stocks that you like to trade, and let's see if it fits the rules for an iron condor, or even if we can trade it as a option. Okay, Wynn. Wynn's the first one I saw. All Steve Wynn's things. Oh, good one, and we got it after. It's on the 18th, so we're at, oh, it's on the 20th. So it's after 420. So it's 424. So we have a clean one. We would have to go to the shorter duration here. If you want to do that, that's fine. I would lean away from that. As a matter of fact, this expires on the 20th, it's the 24th. So that's what I was talking about. If you got into this one, volatility is going to continue to expand on you. If you're getting into here, you can see that they have good implied volatility. Wynn does have better markets than what we're really seeing here. These are, really wide right now. So let's just move on just because of all those other ones. Tesla, you think Tesla is market neutral? You haven't been watching my daily market commentaries. Anyway, just kidding. So Tesla, let's check, see if they have earnings loss coming up. It is on the, yeah, so we're going to nail it in there. So there's going to be a lot of them. You can see a lot of earnings coming up next month. Let me see if I see anybody that's picked any of mine. One of them, here's a good one, I think. So let's look at FedEx. Somebody threw out FedEx. FedEx is Yeah, I don't know why they don't let me show the questions. I wish they would, because then I could have somebody else read them out loud for me, maybe. All right. So FedEx doesn't have earnings. They just had them. So we're good there. It's got high implied volatility, as you can see here. You know, it's got that one spike that I was talking about that felt it, but you know, I don't know that we can really discount that spike really right now, especially when we've seen the volatility we've seen. So let's see what the implied volatility percent is for for FedEx. It's above 50, so that's good. All right. And, you know, we could say it's going to settle down here. You know, one of the things markets like to do is settle into a groove around these volume nodes. That's because that's where people are putting their money where their mouth is. Think about it. When you're not making money and you're not losing money, everybody's happy, right? Nothing happens. Okay, well, I don't have to make any adjustments because I'm good. We can throw some Fibonacci's on here. Let's just see what it looks like. It looks like I have Fibonacci. Actually throwing it up, and it's going to be quick and dirty. I'm not going to try and be exact on this, but you know, it's trading right inside of these. You know, we could say, okay, it's going to settle down there. So let's try and pick some points where we kind of want to look at, you know, for safety. So maybe above 55 and below, what is that, 615? So above 55, I doubt we're going to be able to get that far away, but you know, it's a good marker to look at. So somewhere above 55 and 15. So then we're going to go over here and look at the delta on these. What did I say? We're looking for like a 16 delta, and like I said, even with this stock, it's hard to find like a 16 delta. So we could start looking at the 110s. That's the closest to it. You're going to generally have to move closer than further away when we're talking about these deltas, okay? But we can try it out. So let's start out with the puts. That's the 14 delta. So we'll just kind of flip this on there. Going to sell that one, buy that one, all right? That's $10 wide. So we're going to need to at least get a $10 wide one to the upside one. They're all $10 anyway. So with this one to the upside, on an 11 delta, I can tell this distance is not going to make up for the amount of money that I need to get to. So I'm going to go a little bit closer on this one. So I've got the 50, 60, and the 10, 200. So that's close. What I was saying was right in between there, wasn't I saying that? Didn't I say, or was it 115? 115, so I'm below that one. 155 on the upside, didn't quite make it there on the upside, but you know, it's pretty close, and you know, it's probably not going to go up there. So I'm pretty close to within those. I'm pretty good with that. With that being said, you know, we're only collecting $2.30 some cents, so we need to collect $3.30, right? Earlier today, that one was looking pretty good. I got the same strikes. You know, we want that to at least be $3, and it was $3 earlier today. But I bet these markets must have gotten a little wider. You might have to go to do it the 220s, and then go to the 200s and that to get that. And that's closer. So that's close to that 30, you know, we're 20 cents off, and I could probably ratchet this up a little bit because the markets are a little bit wider. I know there's a lot of people in here trading it. And this is what I was talking about. Ratchet it up, get away from that mid price, because they want you to get filled, right? They're defaulting you. If I just go in and sell one, and I'll show you in a minute, they're going to default you to the bid or the offer if you just do one contract. And that's because they don't care, right? They don't care if you got a better fill. They just want to fill you and bill you, is what we used to say on the floor. So it doesn't cost you to go anything to put this trade in and then cancel and replace. Go down a couple of pennies, cancel, replace, put it in. By the time you go back there, the algorithms, the machines in here will, you know, put that spread together and get you the best fill. But if you just hit the bid or the offer, sometimes it won't. Okay. So you know, that's what we would want, is something like that where we're getting a third the width of the strikes. Let's see what I got. One more that I was looking at, Adobe. Sorry, just because we're I got a little bit long-winded in the earlier presentation, so I'm going to start defaulting to a couple of ones that I was looking at. Why isn't Adobe showing up for me? Adobe has no options. Oh, because I spelled it wrong, or did the ticker wrong. Adobe. All right, so Adobe, 42 days to expiration, $200 stock, so we should see these around 20 cents wide. They are, so we're good there, right? That makes that first rule. It's a good stock to trade. My duration is inside of that 35 days. That was the next step, right? Underlying duration are strikes. We're going to be looking somewhere around the 16 delta. I'll probably have to roll it in to that 20. All right. And the environment. The environment, 77 IV%. So let's look at the charts. It's up there. It has a tendency to get up there too. And it looks like it's starting to settle down despite the fact that it has high implied volatility, no earnings, so we're clear there. So let's just say it's going to want to bounce, you know, in and around these areas. So we kind of want to get up here around the 240s and maybe the 205s or something like that, right? Sound good? Like I'm getting pretty far away, right? That's probably not going to happen though. That would be a perfect world. So let's go in here and start looking at the deltas. I see you guys have a couple questions. Let me get this one out real quick. So it's trading around 218. So with that being said, I'm going to kind of look at around the 200s probably, because that 16 delta for $5 wide I don't think is going to cut it for me. We can try it though. I'll try it with this one. So 16. I'm just doing the math in my head on this split here. I can see it's not going to work out. So so that's the 95s, and oh, we don't have $5 tick wides up, or we don't have 5 tick wides up here, so I have to go wider. So let's try the 95s. Sell the 95s, do the 85s, and then 16 delta. I'm probably have to go tighter because I know a 10 delta is not going to make it for me. So bagging that together. Yes, you can set it up. Somebody's asking, can't you just set it up here? Yes, but they're not going to give me the strikes I want. So I always set it up this way, and I click on it, and then I hold down the control button and click on the other one. That's why you can see when I hit the control button, all these things show up. But that's how you build it yourself. See, it says it's custom so far because I haven't added everything into it. But when I do, it will say that it's an iron condor. So I sold the 240 and want to buy the 250s there. That's the one I'm missing, buying the 250s. So you can see it still didn't give that because this one, once this gets to 10, it should say that it's an iron condor. Now, here, I'll show you. I'll show you again. All right, so doing the 95s, doing the 85s, and the other one was the 20 delta, which is this one. So control and control. So $2.25. So it's still a little, you know, we want this. It's $10 wide to be closer to 30 cents. So there's other opportunities out there other than this one, obviously. And of course, all the ones I've vetted aren't working right now. I'll try one off the cuff. But you see where I'm getting at there? We want to at least get a third the width of the strikes. Otherwise, there's other opportunities out there that you can take advantage of. If it's close, you know, let's say a third the width is 33 cents, right? If it's 30 cents, you know, I'm not going to bash you for that, for sure. You know, for one, you have a higher probability of success because you're a little further away. But somebody else is asking about Nike. Let me close that. Nike, high implied volatility above 50. Let's just check this out. You can see that it does. This is what I was talking about, Volatility Crush after earnings. Boom. Nike's a real good example of that. But we don't want to put this on, you know, way back here because look, you know, we may have thought we had high implied volatility, but we're getting into it around here. You can see volatility is going to go up and not going to go away for quite some time. And in that time, you know, your strategy is going to be out of whack for that earnings. That's why I talk about waiting for that. But again, you can see Nike's gone nowhere, but has high implied volatility. So let's look at Nike for a strategy. So probably going to be looking at this 19 delta, because usually it does end up being closer to the 20 delta, but you know, start with a 16 if you can get there. And then on this side, I'm probably going to have to go to, yeah, $2.50 strikes. It's not going to get 67 cents. I had this at 67 cents earlier today, so it was like perfect. But that would be where I'd start, maybe go down to 60 cents on this one. It's probably got to be closer to 70 actually, but 67 cents is where I saw this earlier today, because it's $2.50 wide, so I need to be closer to 70 on that, on those. But that's how we're going to do this, and don't give in to that. You know, just because all the ones I vetted earlier today and working out during the 5 minutes before the close are not looking as good as they were. But keep that in mind. Stick with that rule. It will work out. Trust me. And it will work out more often than not. But try and build it out. You start around the 16 delta. You're probably going to have to go closer to the market a little bit. But that's how we're going to build that out. All right. And I see a couple questions. Can you default to the midpoint? You might be able to, but this is what I was talking about. If I just sell that, look, it just defaults to the bid. If I go up here, it's going to default to the offer, because they want to fill you. And I could probably get filled if I put it in there for like, you know, 2 or 3 seconds at, you know, $1.20. I mean, I might get hit rather quickly. Yes, after hour options pricing is generally not very real. And that's absolutely correct, OM. The reason why is because, do you guys want to leave order, especially in this kind of environment, do you guys want to leave an order in there over the weekend when anything can happen? No. And that's what happens is people have pulled their bids and offers, right? They've canceled everything, cancel all. And that's why the markets are a little funky right now. Okay. I may have missed it. Did you talk about where you take profits or set stops to adjust it, or perhaps one of your other courses? Neil, no. Where I take profits is right around 50% of max profit. So in that other one, when I was trying to get it for, let's just say 70 cents, I would be looking to get out when the underlying, or when my value was around 35 cents. So with the Iron Condor, I'm looking at taking 50% of whatever I collected. Now, great question, because I got sidetracked, and I'm probably not going to get to everybody's questions because this is super important. Okay. All right. So when we're talking about the width of the spreads, all right, let me just throw up something easy that I can try and get something where I can get a dollar wide spread. So let's just pretend Twitter doesn't have earnings. All right, we've got dollar wides. We're going to look for this strategy around the 16 delta, and I'm going to need to collect at least 15 cents on this one. So that looks like it's going to work. So so basically, one other thing is you can figure when you're selling this one and buying this one as a dollar wide, I need to at least get to 15 cents, right, to get to that same prospect over here. So selling this delta, is it going to make it? 31 cents. All right, perfect. So now, right now, our probabilities are set to neutral. Now, what happens when this underlying comes and all of a sudden Twitter starts going down? We get mechanical on this strategy when we're starting to get tested on our break even, where our it's not going to feel like the break even when you see this, but when the underlying trades down to $23, or actually $22, remember our break even is minus, so $23 minus the 23 is $22.69. So when this underlying is trading at $22.69, I'm getting mechanical because I'm getting tested on this, all right? With this strategy, it's beautiful because then you roll, this part of the strategy is worthless, right? my calls, this is going to be zero. I'm going to get nothing for those. So what you do is you roll the calls and the puts down to the at the money. So it's going to be basically turning this into the iron butterfly like we had last month or last week, where we talked about the iron butterfly. This one's great because you roll it down, you collect more credit, and you're probably going to be able to get this where you collect another 15, 20 cents. So now my total collection is 50 cents. So now I've lowered my risk, right? Now my risk is only 50 cents on the other side. You know, sometimes if you do it a little bit earlier, you can make it where you've collected like 60, 70 cents if you're starting to get a little nervous. And especially inside of the 14 days. I think somebody threw out BABA up there earlier, and I don't know where the BABA question went, but could you show the setup on the OCO order or limit order to take profits or to cut a stop loss with a short iron condor later on? I'll try and get to that. Actually watch my daily market commentaries because I got the BABA on. Thanks, Bobby. Appreciate your kind words. So 31 cents, so that's that. But remember, if I'm tested on my break evens, which is that collection on the calls plus the short call, if that market trades up and tests me, move it, go for it. You know, you don't have to go straight to at the money. You could go like a tick or a dollar or two higher, collect another 10, 20 cents. And with that collection, then you still have an iron condor. If it continues down a little further and hits your break even again, or it goes and tests your defined risk, you can go down to that butterfly, collect more credit, all right? Increase your probabilities. So that's the beauty in this when you get tested, especially when you're getting tested close to the end of the options expiration and you're kind of like stuck with it, all right? This is recorded. I am recording it right now. So yes, it is being recorded. So one thing I said is watch it relatively soon. If you're just tuning in now, you probably need to watch it twice, to be quite honest, so that you really remember it. Sorry, a couple questions popped up and I think I missed. All right. Can we expect money amount move for the short strikes? I'm not sure what you mean by that. But that's one of the things I wanted to make sure you guys went home with is the beauty in this strategy. This is why the iron condor and the strangle are one of my most favorite, or are some of my favorite strategies. I don't know why I would say most, but are among my favorite strategies because there's so much flexibility with me being able to collect more credit and things of that nature if it starts going against me. You know, if I started seeing this was maybe going down to a Fibonacci level or a point, and I think, well, now that's probably where it's going to go, I can collect a little bit more credit by just rolling this down, right? And I talked about that basically all week this week with IBM when it was bouncing around. So I had on the strangle with that one. So it's very similar anyway. Okay. Is everybody clear on that roll on? And you can also roll it out in time if you are still sure of it. You could just roll this out, your 14 days in that strategy. It's testing one of your sides, but you're like, okay, I don't think it's going to really, it's maybe close to one of yours. Roll it out in time if you're still convinced that you have the same market assumption. The first thing I would do is probably start rolling this down to collect more credit, but then you roll it out in time, collect more credit, and now you've collected maybe 70 cents and you're only risking 30 by continuing to do that stuff. Okay. All right. So this is the offer you guys we got this week. So if you've enjoyed my presentation or any of that, please take advantage of this because this is a good one to take advantage of because there's so many of them for just 36 bucks. And I've talked about this before. These are all webinars that you can basically go in there and they're kind of listed like this. There's more of a box here where I can check them off. So if I skip around, you can check off and see which ones you've already watched. But these are great, especially if you're a newer or even savvy trader. Savvy traders will be able to take advantage of this protection of your portfolio against rising interest rates. That one alone will be one that will pay off your entire thing anyway. So I'm going to throw this link right in to the chat window. We've been going back and forth on the webinars as going through the questions box, but the link is actually in the chat window, which is another one of those little drop downs. So you guys can go ahead and click on that. So for 36 bucks, all of these webinars is an amazing deal. And right there it is, using market profile to trade options. Somebody was asking about that. I use market profile to trade my options and Fibonacci as well, but also how to generate other monies using option. But this one is really important, especially right now if you're paying attention to the Fed raising interest rates. So obviously the best way to become a better trader, you guys, is constantly learn, and you guys clearly are doing that. But wouldn't you say knowing how to just create an option strategy, going online and learning how to do an iron condor isn't enough? I mean, you need to know what your risk is and why I'm picking the strikes and things of that nature to increase your probabilities and make you more mechanical traders. That takes the fear out of it. You know, right now, people trade and they trade with so much fear and they get in and get out at the wrong time. When you can trade with probabilities and you start thinking probabilities, believe me, I was nervous about my IBM, but I just held my head high. Was like, hey, the probabilities are still in my favor. I don't need to be mechanical yet. I don't need to roll this down. I got the big move up. You know, I didn't make a lot of money on it, to be quite honest, but I did make some money on it. I covered it as soon as we rallied right back up to the point of control and was able to get out. And it was a big loser for a while there, so I was happy to get out for a small profit. It wasn't my 50% of max profit, but I was happy to get out of that one. But I talked through that trade almost every day during the market commentaries. So those are really important. I hope that you guys get as much out of those as some of these webinars too, because every day I'm talking about trading and probabilities and what I'm doing with the trades that I have on. So, I mean, anybody can teach you guys how to build a strategy, but no one else is really going to show you guys how to set it up to increase your probabilities of success. And I do that in these webinars, and I do that in the daily market commentaries. That's how I teach. That's how I talk. And how to play these probabilities. And when the probabilities have gone against us, how we stay mechanical. All of those things you'll learn in these webinars and in the daily market commentaries. All right. So guys, when you're using the right tools in the right situation, you guys are going to be more productive state of mind, and you're going to be able to put on more strategies, which is going to create more opportunities, and then you're going to be building your confidence and be able to stay in these trades a little bit longer. All right. So we're offering this trial today. I suggest you guys go ahead and click on that link in that chat window. If you're watching this on delay, you guys can pause it and type this exactly into your URL and do that. So if you've learned anything at all from me today, you guys should be taking advantage of this knowledge. So what do you say? Go ahead and click on that link right there in the chat window, and we'll get you guys set up straight away. Finally, I just want to say thank you. If I can get to my thank you slide for some reason. Oh, it's because I got this up. Sorry. All right. Here's also the link right here, how to trade options like the Wolfman. Where is it? I lost it. Anyway, so the chat window it's in there. That's the link for the other one, Volatility Crush. We were going to do, but we're not going to do that because volatility is not going to crush anytime soon, I don't think. It may kind of come off a little bit, but it's not a crush. So anyway, this is the one we're going for here. So type this into your URL right there. All right, thank you guys all for participating in this. I love the give and go with this. The questions make it move a little bit faster. That's all I got for you guys today. Other than if you can't take that, take it easy. All right, I can see a couple of questions I missed there, so I'll go over those real quick that were popping up while I was going over this. So I don't want to leave any of you guys out. Great webinar as usual. Hope you have a tremendous weekend. Thanks, Ted. Take care, buddy. What was the other one? Instead of the roll when the stock price close to the short strike, would you do a synthetic? Well, I wouldn't do a synthetic. He's asking if I should do a synthetic long or synthetic short when it approaches that. To me, you're kind of doubling up your position, and you're also starting to make yourself more directionally biased, right? So if you are more directionally biased now, I would probably start to look to close this strategy out. You're not going to be able to cover the side that's being tested and make up for that in the side that's not necessarily. So I wouldn't probably throw it out there. I'd probably just get rid of it and maybe do a completely new strategy around that new directional assumption. But I like the roll better. Your probabilities are still your probabilities. So I like to do the roll down or the roll up and make it a tight iron condor. And then, if that opportunity arises where I can make it, or, if push comes to shove and I make it into an iron butterfly, then I'll do that. And I've even been known to invert, lock in a loss just so that I don't lose more. You know what I mean? So if I wanted to lock in a loss of 20 cents and try and collect enough credit to make my total 80 cents, and I know I'm losing 20, I'm sometimes good with that as well. So you can invert. And I talk about doing that inversion on a whole webinar where I talk about defending the iron condor and defending the iron butterfly. But I just wanted to give you guys a brief overview of that real quick. All right. Do we sell spreads on the bad side to reduce risk? If you sell it on the bad, if you sell more, you're adding more risk to it, actually, because that's the side you're being tested on. If I were anything and it started making that directional move, I'd be probably adding more to the side that wasn't being tested. That makes sense? Yeah, the link is right there in the chat window, you guys. Okay. All right, guys. Everybody have a great weekend. Take care, guys.